Hi, this is Kyle McFarland with Burney Wealth Management, and I'm joined today by Adam Newman, who is a partner and senior wealth advisor on our team. This is Byte Size Retirement, where we take common retirement planning topics and break them down to bite-sized 5-minute pieces. These are not investment or tax advice, but hopefully help remove some mystery and provide a solid foundation to plan off of. Remember, while we might be explaining a topic in 5 minutes, do not take 5 minutes to make any of these decisions. Today's topic is around balance sheet diversification. And to kick it off, Adam, why don't you just define what a balance sheet is?
So a balance sheet and the creation of a balance sheet is a foundational exercise in any financial planning process. So it's the first thing you want to do before getting into the weeds on investments or cash flows or anything else related to planning for the future. A balance sheet is going to give you a snapshot of where you are today. And most importantly, it's really going to take your assets, everything you own, across various types, whether it's investment accounts, cash accounts, retirement accounts, real estate, and it's going to subtract out what you owe, any liabilities related to, credit cards, mortgages, auto loans. And when you take what you own and you subtract out what you owe, you get your net worth. And that's a really important number for people to understand and track and monitor over time. And what a balance sheet also does, it helps you understand what kind of concentration you have across different types of assets. So out of my net worth, do I have too large of a percentage in real estate? Do I have a too large of a percentage in cash? And, so those are the kinds of things you want to be mindful of as you go through that exercise and think about how are my assets currently structured? And Kyle, specifically, when you think about the structure of our assets and what that means for retirement planning, what are some things that you think retirees should be thinking about?
Yeah, great points. And it's important to first understand, where is all my money located? So you just talked about, do you have too much in real estate, too much in cash? One very important thing to consider is, what is the tax impacts of all the different accounts that I have money saved? So in the context of most retirees, they've got some IRA money from an old 401k. They might have funded a Roth IRA, and then they might also have just a taxable brokerage account. All three of those accounts could have $1 million in them. And the net result of that is not $1 million coming to you in the form of cash. If you withdraw from an IRA, you're going to have significant taxes to pay. The Roth is the one account where you can actually pull the money out and have no tax consequences. And then a taxable account is based on short-term and long-term capital gains. And so it's very important for you as the client, the retiree, to understand that $1 million is not equal depending on where it is. So your net worth is very important to define, what the after-tax net worth that you actually have. If it's all in IRAs, you've got a lot less money than someone that's got the same amount, in a taxable account or a Roth IRA. So with that in mind, Adam, I've got $1 million in an IRA and don't have a lot of diversification in other places. What are ways that I can maneuver my balance sheet to maybe put myself in a better position?
And I think just the process, Kyle, of understanding, where you are now helps you set yourself up for strategically making some decisions to better position yourself for the future. And you can break this down into two really windows of time. If you're still working and still saving, you can just simply start by reallocating where you're putting, those extra dollars. So if you've been heavily saving into pre-tax retirement accounts over the years, and we've really decided that it makes sense to start to position more towards Roth, you can do that. You're still working, so you've got time. Or if it makes sense to fund a health savings account if you haven't already been doing it, or if it makes sense to start actually earmark more dollars to taxable brokerage accounts or cash accounts to better set yourself up for flexibility in retirement. Still being employed and having income and cash flow to work with allows you to do that and go through that planning exercise proactively. If you've already retired, don't worry. There's still options that you have to consider. The easiest one being, if you fall under the camp of what a lot of retirees do, where you have a lot of pre-tax retirement money, you can start to strategically convert some of that pre-tax money to Roth over time. So we did a video dedicated just to Roth conversions that you can go back and check out, but a Roth conversion allows you to move funds from a pre-tax bucket to a Roth bucket. So if you've just retired and you don't have income, you can, really start to make those conversions and, build that additional layer of flexibility. So those are a couple of, really common examples. But I'd say the key thing here is, transparency, knowing where you are, And also every year reevaluating whether you're working or retired, what are your options to strategically reposition things to help your assets last longer and to give you that additional layer of security.
Awesome. Well, that's 5 minutes. And that was a Byte Size Retirement episode on balance sheet diversification. We're going to be linking down below our most recent blog on balance sheet diversification if you want to jump to this topic further. And then I would also encourage you to take a look at our Roth conversion Byte Size Retirement video. Leave a comment below if you have any other retirement questions that you want answered.